Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Since late 2020, our technical market patterns have been warning of market problems occurring in August 2021. These patterns have been consistent as market distortions and internals only deteriorated further. As we now begin August, it is essentially important to consider market risk versus expected returns. Returns that must be generated from current historically high valuation levels that itself alone makes it riskier. We're not going to spend a lot of time on technical patterns, which can be found on our site. We're going to talk market risk. We'll cover the areas listed here. Hopefully, I'll be able to illustrate the importance of some key risk concerns we have. Those concerns are the U.S. equity market is now so distorted from acceptable historical measures that some level of risk adjustment should be expected and is required for markets to operate in an orderly manner. We are seeing inflection points in other markets that normally have an impact on U.S. equities currently occurring. We're seeing distribution occurring, which is typical of equity markets reaching some level of short to intermediate top. The level of passive investing through ETF index funds is now extreme and has never been tested actually if large numbers of investors were to hit their sell buttons concurrently. Though they are selling a single ETF, that ETF index must sell a broad array of index holdings, which the market must absorb with offsetting buyers. There are strong indicators that the liquidity spigot that the U.S. equities have come to rely on is about to be reduced. Let's start with the August window, which we've been expecting to usher in market problems. August through October has historically been a weak period for the S&P 500. The 2021 market movement since January additionally mirrors the historical period of strength. There is obviously no certainty that this pattern will be repeated, but the probabilities increase when distortions in fundamentals, risk, sentiment, which the current market is experiencing, are significantly above trend. This window features a number of events that historically have been problematic for equity markets if the market is particularly fragile. Any one of them have triggered abrupt market responses in the past. They are a tough gauntlet to run through if underlying market support is not strong. We believe this is the case this time around. The gauntlet kicks off during the height of the summer holiday period with the August options expiration and historically low trading volumes. The August Jackson Hole Economic and Monetary Summit is watched closely as it often signals subtle shifts in the Federal Reserve policy thinking. The September and October events are built around the realities of whether the market analysts' proverbial year-end hockey stick forecast will be met or not, and how much they need to be brought down to match the realities of year-end financial statements. Additionally, analysts and brokerages begin going on record with their calls for the following year. It is tough for distorted markets to get through this window unscathed. Problems with market fundamentals, risk, and sentiment must be rationalized as sustainable or not with supporting analytics from market pundits who now place their reputations on the line. In the November 2020 Under the Lens video, I outlined the process that schematically is shown here that we at MataSII.com rigorously follow. The highlights are that fundamentals defy logic in all categories against historical measures. The fundamentals have disconnected from the economy that support them on even the broadest measures using the Wilshire total market measure. The total leverage being employed to support the economy and market is at unprecedented levels as a result of what can only be termed Federal Reserve and central bank madness. Margin debt used to finance financial securities is off the charts, especially measured against free cash balances. Everyone is on the same side of the boat. Who's left to buy? Historically, this has been a sure sign that a period of reduced risk lies ahead. Sentiment has been bullish for an extended period of time, which mirrors an extended business cycle, which we'll show in a moment is already reversing. The FOMO, or fear of missing out, is rampant as Robinhood traders now run in large packs, endlessly driving stocks through controlled pump and dump cycles. These are the signs you watch for and get when even your barber tells you which sure thing stock he is buying and neighbors give you investing tips. Historically, never a good sign that all is well in the markets. When we consider markets that directly impact equities, we are also getting worrying telltales. They are approaching important inflection points. If we take a 30,000-foot view of the markets, we get a somewhat clear and telling perspective. Industrial production in the U.S. stopped growing 20 years ago with China's entry into the World Trade Organization, or WTO. This year's annual industrial production was substantially negative and concentrated in the past 5 years as an artificially driven economic rebound from the 2008 financial crisis, driven by numerous rounds of quantitative easing, drove financial assets, but not industrial production. The U.S. pays its bills to foreign producers through what the U.S. produces, or can borrow to make up the deficit. The U.S. is a 70% consumption economy, now consumes far more than it produces, while major lenders like Japan and China have stopped buying U.S. debt that supports that consumption. COVID-19 has significantly compounded this existing problem even more. Though U.S. industrial production has rebounded from the COVID-19 lows, it has stalled below prior levels and is quickly rolling over and forecast to fall to lower levels. This mirrors the expected decline as a result of the U.S. business cycle retreating from one of its longest runs on record. This was driven primarily as a result of massive rounds of quantitative easings, which, as would be expected, brought future demand forward. We soon faced the reduced demand it wrought as stimulus checks stopped. There's a big black hole here. Overlaying this with the Chinese credit impulse, which leads U.S. economic activity by 12 months, it is to be fully expected that U.S. economic growth will deteriorate beginning during our highlighted market window. We should be expecting no less. Hoping for this not to occur is simply not an investment strategy. But in delusional markets, reality is often not a consideration until it suddenly is. The yield curve has now abruptly flattened, which occurs when slowing economy growth becomes apparent. Though we have found temporary support, the question is whether yields will go up from here or down, taking with it the yield curve. With key governors now talking about tapering of QE from $120 billion per month being a real possibility, the expectations have been growing for yields to start rising again. Friday's July non-farm payroll release sent a confirmation to the market, with a print of over 900,000 jobs and upward revisions to prior months. Bonds exploded higher. Precious metals got taken out to the woodshed while the dollar surged. If the yield curve begins to fill the pink box shown in the right, then historically we should expect to see an equity event unfold similar to 2000 and 2008 as shown on the left. Inflections are also showing in real rate as they have broken support and appear headed lower to possibly negative 1.5%. The dollar continues to strengthen in the counter rally we've been predicting, with the expectations that the DXY will reverse somewhere around 94 and then head lower. We laid this out in last month's LONGWave entitled A Pressure Relief Valve Required. We also have inflection points in inflation and economic growth as they warn of almost an assured era of stagflation, which is not normally good for stocks. Again, we laid this out in the recent edition of Under the Lens entitled It's Official, It's a Ponzi Scheme. This takes us to the pattern distortions in the S&P 500. The path that we are on is something we forecast when we first began quantitative easing after the 2008 financial crisis. This chart we first drew in 2012 concerning what we saw as monetary malpractice. We felt assured of what the predictable outcome would be if taken to full measure, which it was and did happen. We laid out this roadmap a few years later and last updated it in the November 2020's Under the Lens video entitled Market versus Economics, shown by the red circle, when we were in stage 3. We believe we've now entered stage 4, shown by the blue circle. What has ensued is the red bubble labeled and rationalized as disruptors. This is a period of low to slow growth, low reported inflation, and low rates. We now have high reported inflation as markets temporarily still continue to rise. I believe no one can realistically describe this chart as normal, but it was what we should have expected and in fact have got. And as would be expected with such a chart, it must at some point at least consolidate some of its gains and find firm economic, fundamental risk and sentiment support. Normally, this is found at lower levels. We are seeing the early signs of this in key distribution signals. The Wyckoff market cycle is an easy way to detect this. At highs, we get signs of distribution before markets mark down prices and start the cycle all over again. Wall Street lives off and depends on this markup and markdown cycle, just like retailers selling any product. We see here two representative examples which are well followed and highly traded. Both clearly show what is likely occurring across the equity realm in some fashion. When we plot Bitcoin against the S&P large cap stocks, we see that a divergence has appeared on the right side. This is a sign of potential risk off, and we also suspect of a coming problem stemming from the short-term funding market and the increasing use of reverse repos, which directly draw down bank reserve balances at the Federal Reserve and result in effectively shrinking liquidity levels. What can we conclude? The major concern is any change in the rate of Federal Reserve liquidity. The liquidity is best measured by the change in total bank reserves held by the Fed. There are four drivers that create a contraction. Repayment within the discount operation windows. This seems remote. Currency in circulation is increased. This is likely, but not a major concern, as shown by the green line, but not seen as I said, a major concern, at least yet. Treasury deposits at the Fed increase. This is also not a major concern. Or reverse repo levels increase. This is a major concern since they've already spiked to $1 trillion, and many are calling for doubling from this level. It was only a few years ago that they were down measured in a few million. Bank reserve liquidity will fall if QE tapering were to begin. Overall market liquidity will fall if the Treasury's debt ceiling is not suspended again because Treasury spending will be crimped. Bank reserve balance will not grow if ongoing Treasury supply is not issued or rolled over. All these are major concerns going forward, and global markets are watching closely, as you should be. We feel the Federal Reserve is adopting a policy strategy of what they believe is controlled inflation. Controlled inflation to them means higher inflation and inflation break-evens. We also expect lower real rates approaching possibly negative 1.5%. This suggests to us that the 10-year U.S. Treasury nominal rates could potentially rise towards 2.5%. If inflation falls back significantly, even at 2.5%, and real rates hover higher at negative 1.0%, it still suggests 10-year notes at higher levels than they are currently trading at and a slightly steepening yield curve. Watch all these levels closely during the coming 3-month gauntlet window the equity markets must run through. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will actually take the money or there's no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.